again, welcome to today's webinar entitled Rational and Irrational Choice in Flood Risk Management. Our presenter for today's webinar is Dr. Craig Landry, a professor at the University of Georgia and a natural resource economist with expertise in non-market valuation, coastal resources management, and experimental economics. His research agenda includes individual decision-making under risk and uncertainty, risk management, insurance, and mitigation for natural hazards, dynamic optimization models for studying coupled human-natural coastal systems, modeling of recreation demand, including beachgoing and recreational angling, experimental economics for assessing non-market valuation methods, and willingness to pay for public goods. He has served as a review panelist for the National Science Foundation, Environmental Protection Agency, and National Oceanic Atmospheric Administration Sea Grant programs, and was the lead author for the National Climate Assessment chapter on rural communities. Just a quick reminder once again to our audience before I hand it over, please use the Q&A box for presenter questions and use the chat for any other comments that you'd like to share. And without further ado, I'll hand it over to Craig.
Thank you, Sherry. Let me share my screen. Greetings from Athens, Georgia. I hope everybody's having a good day. I want to say thanks to Shari and Andrea for asking me to share some of my research on flood risk management. As a resource economist who looks at human behavior, what I'd like to talk about today is both rational choice models and how they provide a baseline for quasi-rational or seemingly irrational behavior, and what we can learn about insurance and self-protection and how that might lead to policies that might improve resiliency and safety. I'd like to recognize IRIS, a group that I work with at UGA who studies resilient infrastructure systems, and also the group at the Army Corps of Engineers, which is the Network for Engineering with Nature, who helps to sponsor a lot of my research. The coastal risks that I want to talk about today are mostly going to be focused on flooding, but also erosion and wind damage are also going to be relevant. These are trends, these are catastrophes that are becoming more problematic as we develop coastlines and change land use, and we witness changing climate. Major issues that have to do with vulnerability here include lack of insurance. There's increasing evidence that there's an insurance gap where we're not protecting ourselves financially from some of these risks, and also mitigation efforts. So investments in ways to protect ourselves can be complicated by certain kinds of problems like misaligned incentives or uncertainty about investment strategies, or the fact that they tend to be public goods where we have to have collective action to provide them. So in that context, I would like to address the broader research question of how can we use rational, quasi-rational, and irrational choice models to better understand decision-making and provide information on risk management and adaptation policies. So when I say rational choice, I want to make sure people understand what kinds of model I'm talking about, and I'm going to go back to a really old formulation of how people make decisions under uncertainty. This goes all the way back to Daniel Bernoulli in the 17th century, who was trying to understand how people would evaluate outcomes that they were uncertain about. And what's beautiful about this model is it's very tractable. It's been used in all kinds of modeling simulations to look at insurance markets, mitigation practices. So that's the merit. Some of the problems with this is it doesn't seem to be very realistic, or it doesn't seem to describe human behavior in a lot of contexts. So the basic idea about expected utility theory is that people should weight how they feel about certain outcomes by the probability of those outcomes. And if the evaluation process matches certain assumptions, we can make predictions that they'll buy full insurance as long as it's fairly priced, and they'll invest in mitigation measures if they have a positive net return. So that's informative in that we have a model that allows us to make predictions about behavior. The model is formulated on some assumptions, and to the extent that this model does not describe behavior, it gives us an avenue to explore people's perceptions, because we can look at the assumptions of the model and see if that's why we're failing. and that tends to be what we find here with this particular formulation is we have mixed evidence of whether or not this really does a good job of describing people's behavior. If we do find that this model doesn't work well, there's alternatives, and I'm particularly interested in trying to assess which of these models tends to work better in different circumstances with different types of people. And I've listed some of the alternatives here, but there's a whole slew of different ways to think about choice under uncertainty. And part of what I would like to do before I retire is to come up with a way to try to see which one of these work better in different circumstances. The focus today is going to be on catastrophe risk, which is particularly problematic because it tends to be low probability, high consequence risk. So the implications for low probability is that it's often off people's radar. So when we examine their behavior, they could be myopic. They could ignore certain risks because they don't reach a threshold by which they think they would need to attend to them. So that's from the demand side. And then from the supply side, in terms of selling and providing insurance policies or coming up with a plan to pool risk, these distributions tend to be fat-tailed, so they don't follow normal probability laws. There's a lack of data on historical and projected losses because they're rare events. So it makes it difficult to identify risk and to price policies. And if we're going to sell policies and try to plan for future risk, we do need to think about simulating how risk will change with the future. Another problem with selling insurance in this domain is that risks are correlated. So if you're a single insurance provider in an area and there's a loss, there's going to be many losses. So this makes it difficult to diversify risk, which typically means you have to have a really large scale of selling and servicing policies. So the domain of catastrophe risk makes this research difficult, but also important. And to say a little bit about insurance and mitigation, which is what I want to focus on here, because these are ways that households can protect themselves. Insurance, I'm sure most people are familiar with this, but essentially it's a risk sharing mechanism. We tend to think of it as in other ways, especially when it comes to healthcare, but it really is designed to diversify risk. And in its simplest mutual insurance way is you pay into a pool, and then when someone suffers a loss, they get to withdraw. That's the simplest model of insurance. And if we go back to that expected utility model, that model tells us that if people are risk averse, they're willing to pay a premium to avoid risk, and insurance markets should work well from the demand side. From the supply side, again, providers have to be able to identify risk levels and factor that into prices in order to supply it. So we have models of how insurance markets should work, and they often poorly predict demand, and sometimes we have difficulties with supply as well. When we talk about mitigation and adaptation, there are limitations there to using those tools as well. They require technical expertise that's often not available at the local level. They can be very costly. They're often large scale, and they require public support in order to implement them. And when you're looking at something that's an unlikely event, sometimes people aren't willing to support investments that may not pay off unless something rare happens. The context of my research is going to be in the United States, and I'm particularly interested in the National Flood Insurance Program. This requires floodplain management regulations. The government maps floodplains. We realize there's some problems with their maps, but this is how the program was originally set up. After having problems with insurance take-up, there's been a requirement to hold insurance if you're in a high-risk flood zone and you're a mortgage, and this applies to a lot of households. In order to get this enforced, lenders are responsible to enforce this measure, and despite numerous attempts to try to make this stick, it's been shown that a lot of households in the flood zones don't have flood insurance. So this is kind of the conundrum that many researchers have attempted to address. So that's the context of my presentation today. I'm going to present 3 papers that get at this question of why is market penetration so low? And there's multiple potential explanations. The ones I want to focus on are highlighted on this slide. I want to first talk about risk perception. This is something that's difficult to measure. I've come up with some ways with colleagues to try to do this, and it's not clear that we've found the silver bullet here to measure risk perception, but we can learn a little bit about risk perception by comparing what people perceive to what objective data say. The second paper is going to talk a little bit about risk preference, and this is also known as risk tolerance. How willing are people to take risks? This is going to affect their willingness to pay for insurance. The last topic is known as charity hazard, and this is kind of my irrational or behavioral paper that looks at whether or not disaster assistance may be limiting take-up of insurance. So those are the three topics that I'll touch on, and they all come back to this idea of United States flood risk and insurance take-up. So to talk about risk perceptions first, most scholars tend to think about risk in a quantitative way, where we think about a risky outcome as being a product of a probability and a consequence. Once you have this structure, there's a lot you can do in order to assess how do people perceive risk. Comparisons of subjective to objective risk, however, have been fairly uncommon. There's about 4 or 5 papers that have come out recently that have tried to examine, are there systematic differences between what people think is the risk they're exposed to and what a risk model would say they're being exposed to. And those results can be summarized as follows. It looks like there are overestimates of the likelihood of flooding. So people think it's more likely than it actually is. But when it comes to consequences, they tend to think the consequences are not as bad as they actually will be, whereas other results are mixed. And Shari, if there are questions, you can jump in with them at any time.
Perfect. I think we just got one right now. So okay. I think it's just a little more background information on the NFIP. But if the NFIP requires flood insurance for properties in the 100-year floodplain, why do only 30% of homeowners in the floodplain currently have insurance? This seems to suggest poor enforcement, monitoring, or implementation.
Yep, I think it's all of those things. The enforcement is being put on lenders, and lenders often sell mortgages to other people. So there's not an enforcement mechanism in place, essentially. And it's not clear why that's the case. I don't know why it's not escrowed like a lot of homeowners insurance is, but that it's typically not.
Perfect, thanks.
Sure.
We don't have any more questions for now, so I think you can probably continue.
Okay, if I see another chat pop up, I'll stop and ask if you
Perfect, will do.
Okay, thanks. Okay, so the first paper is intended to measure risk perception and look at how it differs from objective risk. And this is tricky because we don't really know how to measure risk perception. A lot of people, people have limited quantitative assessment skills and often don't think in probabilities, whereas as modelers, we want to measure things in probabilities. So I've been working on this, and I know other people have. How can we devise instruments to measure perceived risk in a way that makes sense to people? And I've got a few here from a recent survey we've done for the National Science Foundation looking at coastal adaptation. And I'll spend a little bit of time just describing these questions to you. And if anybody has feedback on these, I'd love to hear it. But these have gone through pre-testing, and we tried to hone them to get what we thought were reasonable representations of what people think is the probability of a bad outcome. And they're expressed over different time horizons. So the first one asks about the next 12 months. What do you think the percentage chance of a flood is? And it could be a flood from any source. And this is something that people have struggled to answer in the past. We put this in a bevy of questions. I've only included a few of them here, but one of the things we were trying to do in this survey is to triangulate risk perception. So we have a lot of different measures, and we're curious to know which ones correlate with objective risk and which ones do people feel more comfortable answering. The reason I've chosen these 4 to share with you is that we have objective measures of these outcomes, and ultimately we want to compare them. So the first one is about flooding in the next 12 months, and it asks for a probability. The second one asks about the number of hurricanes that someone would expect to pass in the vicinity of their community, and it's over a much longer time horizon. So you can see we're trying to back into a probability here by having a count and a time window, we can infer a probability from that. So those are both on likelihood. The next two questions are on consequence. Again, this is the other part of the equation. So we ask people if their home were flooded, what do they think it would cost to return their home to its prior condition? And then for the hurricane consequence, it's going to be a bit indirect here. We ask how much damage they expect would occur if it was a category 3 and it passed within 60 miles. And we have a sliding scale here from 0% to 100%. And we know their home value, so we can calculate what their perceived damages are. So these are ways that we're trying to get at these important risk perceptions that we believe, underlie behavior, but there's no guarantee that we have the right instrument here. And I do think this is something we could do lab experiments on to see how good are these at actually measuring risk perceptions, which is something for future research for myself and other people. So what we want to do is compare these to objective risk measures, and we're lucky to have access to the First Street Foundation's Flood Lab data, which allows us to get at those 4 questions and actually get at objective measures of what that outcome could be, in rigorous ways using, machine learning and Monte Carlo tools. So for an example of what the outcomes look like for someone in our data set, this would be our estimated distribution of hurricane damage. So, we can take the mean or the median of this, and we get a sense of what the objective risk would say using some of the best, or the most up-to-date tools from the toolkit of doing risk assessment. So I'll show you a few results here. I see there's maybe a question up there. I'll pause for 1 sec.
Perfect. Sure. So are the consequences in monetary terms versus social ones? For example, how much stress would it cause, would it take to experience a flood, to make the analysis more simplifiable or scalable?
Great question. This is in monetary terms. We're particularly interested in looking at insurance, which really just compensates for monetary damages. Whether or not this could be taken to the domain of stress or other types of depression, I think is really interesting. I think people would have a difficult time forecasting that as well. I think that's an interesting idea that I hadn't really thought about doing it, mostly because we're in the domain of insurance, which is not going to compensate for stress or depression. So I can show you some of the data here. And so what we find using our instruments are that people tend to overestimate risks in the way, at least in the way we're measuring them. So this is a little bit different from what's been found in the literature. So you can see the inferred flood probability is a little bit greater than what we would estimate objectively, but pretty close. The hurricane probability is significantly greater. I think that may have something to do with the way we're measuring the hurricane occurrence, though, because it's a much bigger space, whereas the objective probability is actually striking their house. And then the damages, you can see people expect damages in our instruments to be significantly greater than what we estimate from First Street Flood and from the National Hurricane Center in the US. So that just shows you generally what we find. Most of this paper spends time looking at the differences at the individual level, and I have some results there that I can kind of describe for you. So running some statistical models, we find there's a lot of noise. We don't do a good job explaining the difference between subjective and objective. And again, I think a lot of this comes back to, are we measuring subjective risks correctly? And how do we measure this latent construct? Couple of things we do find, though. Someone who's has had previous flood damage is more, they're more likely to have higher subjectives of likelihood and cost. So experiencing a flood makes you, increases your subjective perceptions of risk. And this could be in the short run, because some of the research we've done previously on housing values shows that this risk premium can decrease over time as people become more concerned about other issues. If the flood damage you experienced was years ago, it may not be salient anymore. Another thing that we included in this was affect. How much does somebody worry about loss of livelihood or loss of their home? For those people, we see that they have higher subjective perceptions of likelihood and cost. So maybe not surprising, because we know worry and dread factor into the way people perceive risk. So those are, I would say, consistent with what we found with what's been found previously. An interesting thing we find is that the FEMA flood designations are positively correlated with risk perceptions. So currently, the FEMA flood maps are what's recognized as, official flood risk information. The new data from First Street Foundation is undoubtedly better, but just beginning to be released, and it's not correlated at all with perceived risk. So it looks like people are getting information from the FEMA flood maps, and the fact that they are, we know they're flawed in certain ways, suggests that there is an information problem. And the fact that First Street is attempting to address this by getting individual level flood risk out to households is probably a good thing. So in general, to summarize a little bit of this, we find there are information problems. And what's a little bit strange is that our data suggests that most people have pessimistic risk perceptions. So they tend to think things are worse than they are. And this is really at odds with the insurance gap story, because you would think if their perceptions were, flood risk is high and the consequences are terrible, they would be more likely to take up flood insurance, and that doesn't quite fit the story. Okay, and the last thing I'll say here is, as some people think that what we should do is take objective risk perceptions and try to reweight them in a way that might fit perception. So what this slide does is, so if you see the gold line that runs at a 45-degree, that would be, all of the dots would be along that line if subjective and objective were the same. And you can see the blue dots are all over the place. So some people overestimate risk and other people underestimate risk. So one thing my former graduate student, Dylan Turner, did was to see, can I make these line up better if I use some of the weighting functions that people use in the literature? And as you can see, none of these seem to work really well. And it does seem that different approaches may be necessary for folks that underestimate versus folks that overestimate risk. So this was just an exploratory analysis to see if we could do a better job mapping subjective into objective, and really it did not work. So I'm going to turn to risk preferences now, but I'll pause for 1 sec if there's any questions about that first paper that looked at risk perceptions. Okay, hearing none, I'll talk a little bit about risk preference. Risk preference has to do with how much are people willing to tolerate risk. And what's often done is ask people blunt questions about, how willing are you to tolerate risk in general, or use a structural approach and experiments to try to tease out what economists would call structural parameters. And those are really the two approaches that get used in the literature. And the background here is, if we can observe people making choices over risky outcomes, we can start to gauge their level of risk preference, again, going back to that formal model of expected utility or a generalization of expected utility. Their risk-taking behavior comes down to a single parameter, which may be too simplistic, but it's very informative if it does fit. So it's a model people want to use if it works, whereas if it doesn't, then we may have to go to something more complicated. So this paper is meant to measure risk preference in a very stylized and specific setting. So this involves doing field experiments, which give us a lot of control over describing an outcome and the context in which resolution of that outcome will occur. So instead of doing a laboratory experiment where I roll a die and I have people bet on the die, I want to take an experiment to the field because I want to observe people making choices in the field. And I also want the random outcomes that people are gambling over to be related to the risk that we're measuring. So that's what I'm going to present here. Is we're going to use a survey to do an experiment to measure risk preferences in the field, and it's going to be related to weather risk and flood insurance. The one problem that we run into, though, is every time we've talked about risk, we've talked about multiplying probability and outcome, and that creates a difficulty, because if you're multiplying something, there are multiple levels of probability and outcome that would give rise to the same choice. So it's difficult to separately identify these two important parameters in choice models. For example, if we think about employing this expected utility model or one of these generalized models, we would expect someone to mitigate or purchase insurance if the expected outcome was greater under taking that behavior over not. However, if we don't observe the probabilities with certainty, we run into an issue because, for example, if someone was risk neutral, they would always just take the expected value that's higher from a gamble. If we introduce a little bit of uncertainty about probability, though, we lose the ability to say that. So this slide shows you that if we know the probabilities with certainty, so we know, let's say there's a flood and a no flood outcome, the black line there shows you that the expected value of buying insurance is going to be greater if you're risk averse. You won't buy insurance if you're not risk averse, and you'll be indifferent if you're risk neutral. So that black line crosses at row parameter 0. However, if we introduce a little bit of error to the probability, so we no longer agree on the probability of a flood, you can see that crossing point, which should be at 0. If we add a little bit of risk to one side of the outcomes, it moves to the right. And if we add a little bit of risk to the left side, it moves way to the left because it's a nonlinear model. So if we don't know the probabilities with certainty, we can't say whether somebody's risk averse or risk loving is what this is intending to show. So we're trying to get at this with some of our survey data. So let me show you what we tried to do here. So this is a very wordy question. Wordy slide. Let me just describe it to you. So in the context of our survey, we paid people to participate. And we said, you now have the opportunity to gamble your, we couldn't use the word gamble. We had to say, we said gamble, I can't remember what we said. Anyway, you can think about it as a gamble to make things simple. So you can take your $5 and you can wager it on one of 4 outcomes. And these 4 outcomes are based on historical data, historical weather data at the location that the respondent is located at. So we have historical data on weather, and we pick increasingly unlikely outcomes, and we give them increasingly more money if that unlikely outcome occurs. And then these weather outcomes occur the month after the survey has to be returned. And then once the uncertainty is resolved, we then send out payments. For this particular one, nobody got a huge payout. But in the last round that I did in Dare County, North Carolina, one of the high temperatures hit, and we had to pay $450 to a couple of people. So again, what we're trying to do is measure risk preferences. So if people are risk loving in the domain of weather, they might be willing to gamble their $5 on getting more money under these different circumstances. But recall, our research question here has to relate to, are their perceived probabilities equal to the historical probabilities? Or do they think the weather outcomes next month are different from what we show them? So in order to assess that, there's a follow-up question here that says, do you think the likelihood of these outcomes is greater than or less than what historical probabilities would say? So what we have here is choice over weather lotteries with real cash. So there's an incentive for people to take it serious. The future weather outcomes are exogenous, right? We don't control that, and they're verifiable because they can look at their own weather data. They're also relevant to the people because they're occurring, in their community. And then this follow-up of the subjective risk adjustment allows us to incorporate beliefs and whether they're different from historical beliefs. So what we're trying to do is identify risk-taking behavior and also risk perception simultaneously. The approach we take here to adjust their probabilities is going to use a Monte Carlo. I won't go into the details too much, but essentially, if we know that they say the historical probabilities are slightly too low or much too low, we're going to draw an adjustment, and we're going to rerun the model, and we're going to do that under multiple assumptions about the adjustment. So it's basically just a way to try to control for their stated beliefs about the probabilities. Whoops. Okay, so again, this just tells you what the adjustment is. We're taking the objective probability and we're adjusting it according to what they said. So a quick summary of the results here. Most people did not buy the historical weather probabilities. And a lot of research assumes that objective probabilities are what people use when they make decisions. So these results suggest that's not the case. Everyone wanted to adjust it a little bit, or a lot of people did, sorry. Less than 25% concurred with all of the probabilities. So what we're going to do is adjust their beliefs about outcomes and then see what does that imply about their risk-taking behavior. So I'm going to run a model of who has flood insurance and who doesn't, and I'm going to include our the adjusted risk parameter from our procedure, as opposed to just assuming that the data without adjustments tell us what's going on. So we see some differences looking at the influence of risk preference on the take-up of flood insurance, and I would probably focus here on the marginal effect. So this would say someone who increases their risk aversion by 1 point increases the demand for flood insurance by 9.6%. And you can see as we adjust the probabilities, we do get an impact on this marginal effect. Now, initially, the effect is not very big. If you compare these models, they're not great differences across them. It does look like the adjustments improve it, but not greatly. One issue is for many people, the probability that we adjusted was not the probability associated with the lottery that they picked. So if we just focus on those people that actually had an impact of the adjustment, we find very large impacts of our procedure here. So when we focus on the subsample of people who really their choice was impacted by our adjustment, we find that the model that adjusts their perceptions 30 to 60% is the best fitting model. So that does tell us that we can't just assume that historical probabilities are what people use when they're participating in a field experiment. And again, we have marginal effects here that suggest the impact of being more risk averse could increase the likelihood of having flood insurance by about 8 to 9%. And this just kind of shows you what the adjustments look like based on the original data versus the adjustments. Just a pretty picture. Okay, the last thing, I'll stop there for 1 sec. I think I'm doing okay on time. I may need to rush a little bit through this last set of slides. Any questions anybody might have about risk preference? Okay, so this last paper actually was just published in Environmental and Resource Economics, and this is looking at charity hazard, and this is getting into the domain of quasi-rational or maybe irrational behavior. So the idea of charity hazard is that if folks expect generous disaster assistance, they may forego insurance because they think they won't need it. There'll be someone there to help them out. There's mixed evidence in the literature, and there are measurement and endogeneity issues. So that's what we address here. And I think the reviewers that handled the paper were happy with the way that we did it. So we're going to use an instrumental variables approach to purge endogeneity, and I'll explain what the endogeneity is. We also have possible complications with reverse causation. If you're in a flood and you get a disaster assistance payment, with that payment comes the requirement that you have flood insurance in the future. And we're trying to understand how expectations of payments influence take-up of insurance. So there's a potential for reverse causation. So I'll explain quickly what we did in that instance in the next couple of slides. So this is again with my former grad student and a colleague at Mississippi State. So we have a really good data set that looks at households on the Gulf Coast. We measure flood and wind insurance. We ask them about their expectations of disaster assistance. We know about their own personal flooding experience, the history of disaster aid, and we know about congressional Stafford Committee memberships. And this has to do with how aid's dispersed. So this shows you where the households are in the data set. We ask people how likely they think they would be eligible for disaster payments that would pay for home damage. And in reality, these are rare and they're not super generous. You don't often get disaster assistance to pay for home damage. You would get disaster assistance to pay for temporary housing or humanitarian or food assistance. So we're getting a subjective expectation measure here, and we find that a lot of people think that they would be either likely or highly likely to get this assistance payment in our data set. And in terms of experience, almost 40% of the folks in the data set have experienced flooding in the past. So they might know something about disaster assistance. So here's the conundrum that we get into. in trying to do this analysis. And this is part of the reason that results in the literature have been mixed. People have risk perceptions and expectations. It influences their choices. And then there's a hurricane that occurs. That leads to a disaster assistance policy, which can then influence their experience and their expectations of future disaster assistance. So this is the cycle that causes endogeneity that can make inference difficult. And I can show you in our results that if we're not careful about our analysis, we get the opposite effect of the results than we would expect. So disaster assistance policy tends to have a political aspect to it, where, at least in the United States, where it's been shown that aid is more generous in election years and it's more generous in swing counties that folks in Congress think will be important for re-election. So that's part of the exogenous variation that we'll need to use in order to find a causal link. The other complication here is that folks that have received disaster assistance payments in the past have to have flood insurance. So that's the reverse causation, where instead of expectations affect insurance, here payments directly affect whether you have to have insurance. So those are two things that we were able to address in this particular analysis. So a quick sketch of our model, we're going to talk about who has flood insurance and who doesn't, and who thinks that they're likely for disaster assistance. So those are the two things we're interested in. And then in order to purge this endogeneity of expectations, we have to remove folks that might have gotten the payment, and we need to control for elements that will influence payment but not flood insurance. And to do that, we use past payments at the county level, and we also use representation on the Stafford subcommittees, both in the House and the Senate. And this has been shown to be a good way to control for expectations of disaster assistance in other papers in the literature. So the first thing we need to show here, I think I've got about 5 to 10 minutes. I'm trying to stay on time. The first thing that we need to show here is that these instrumental variables are correlated with expectations of disaster assistance. So the results here, you can see that a higher number of senators on Stafford committees and past payouts of individual assistance in years before the survey was done do correlate with expectations of disaster assistance. So that's the first thing we need in order to get some exogenous variation in expectations. Shari, if there's a question, you can throw it up to me, or I can keep going.
Sure. Yep. We have a question.
Okay.
So if a DFA is received, i.e. you're getting insurance, is insurance tied to the property or the person? If property, how is that tracked?
That's a good question. Insurance would be tied to the household, and I guess it would be tracked. Well, I don't think it's tracked. I don't think it's enforced. There is a lack of enforcement in general on a lot of things that we've seen. So I think the enforcement would be if you suffer another loss and you don't have insurance, you're not going to get a second payment. So it's kind of a big stick, and it is at the person, not the household. Or I'm sorry, the household, not the property.
Perfect. I think you can proceed, and we'll take questions as the presentation goes on.
Okay, thank you. Okay, so again, I told you if we were naive about disaster assistance expectations, we're probably going to get a biased estimate. So if we include a dummy variable for people that say they think they're likely to get a payment, we estimate a positive effect on flood insurance uptake, which doesn't make any sense. And that's what we found previously when we worked with this data, which made us start to formulate a strategy to try to get a better an identification strategy for a causal effect here. So once we control for endogeneity and we throw out those people that might have the problem of reverse causation, we get a negative effect, and it is highly significant. So it looks like with the first stage and with this pattern of results that we have been able to get a much better estimate, that we did have bias in the basic model. So I can show you some of the results here. So this would basically be what is the impact of being an optimistic person when it comes to disaster assistance versus a realist that doesn't expect they're going to get the payout. And you can see across an array of models here, the estimates go from 21 to 22 to 42%. So to interpret that, it would say if I'm overly optimistic about disaster assistance, I'm 42% as high as 42% less likely to have flood insurance. So a couple of slides here to discuss what I've talked about in the last couple of minutes. The overall context here is market penetration and behavioral economics, or using microeconomics to understand decision making. So when we look at risk perception, we do find some evidence that people don't have good information if they're just using the FEMA flood maps. The First Street Foundation flood project may have an impact. We'll have to wait and see. We do see that experience increases risk perceptions, as does concern or dread. But there's a lot of noise in these data, and we didn't find as much as we would like to. When we talk about risk preference, that paper is a lot more methodological, but I think the encouraging part about it is that the takeaway is if we collect the right kind of data, we might be able to provide robust measures of risk preference, and that gives us some way to understand, are people taking on risk because they're okay with it, or is it an information problem? And as we get better at identifying risk preferences and estimating models that tell us about risky behavior, something I would really like to do is come up with a general structure for decision making that can tell us, do people look like expected utility maximizers in particular contexts, or do they look like they use other decision models or heuristics? That could give us really useful information about targeting educational campaigns, or understanding why people make certain choices in different contexts, and really different from other folks. So ultimately, some kind of hierarchical model that can help us assess what type of agents use what type of approaches in different contexts, I think would be really useful. And it's something that, again, I'm just very interested in going forward. The last thing I'll say here in the discussion about charity hazard, it is a concern because we know it's going to lead to inefficient outcomes where we're going to have people not protecting themselves, and it can lead to risky development. Our estimates suggest that optimism can lead to big impacts on disaster insurance market penetration. This paper does touch on a couple of policy options, which I'll talk about real quick because I think I have some policy folks in the webinar. It's clear that information is a problem. One of the issues is that these optimistic expectations are very unrealistic. If you look at the history of payments, there's a large variation in disaster assistance payouts, but they're really not big, and they're really not anything like an insurance settlement would pay. So one policy option here is to let people know that this is really not a good alternative to having insurance. One policy option that we thought was relevant builds on a paper by a couple of Nobel Prize winners, where they say that if you have discretion in public policy, it can cause inefficiency. Even if you tell people, if you build there, we're not going to bail you out. If people go ahead and build there, your hands are often tied when the disaster occurs. So these guys make an argument that we should have rules in some instances rather than discretion in order to tie our own hands, which, it seems difficult to implement. I've heard some scholars talk about, constitutional amendments that would limit discretion, which is kind of a radical policy, but it's come up in the past, and that's a potential option here. The idea of compulsory insurance is, I think, kind of obvious. And you could couple compulsory insurance with mitigation investments, where you give somebody a loan for a mitigation investment and it lowers their insurance payment. So, so they're either not that much worse off, or they're at least getting a benefit. Another thing that can be used here is just means testing for aid. So you only get aid if you can demonstrate that you have a need for aid. And that if that's known beforehand, that might combat this idea of charity hazard. Whoops. I think my keyboard is dying, which is why I keep losing control. Okay, last slide. Luckily, I made it to the last slide. So I want to thank everybody for tuning in and listening. I think microeconomics' ability to help us understand behavior and try to model it is very powerful. I do think we also need to incorporate other disciplines, things like affect and worry, and somebody brought up the idea of stress coming from a disaster. I think those are fascinating ideas that are also important in decision making. And I look forward to working with anybody who has ideas about how we can incorporate that into what we're doing. And again, I just want to point out that I really think uh, a large nesting structure that can tell us which models seem to work in which contexts could be really interesting, really useful. I've had a couple of students who've helped me work on it, and we've made a little bit of progress, but it's really difficult to do. And part of the reason I wanted to share the first two papers is um, I think they're helping us get at this idea of learning more about risky choice models and teaching us what we can learn from them and maybe what we can't. So I'll stop there. Again, I appreciate the invitation, and if there's remaining questions, I'm happy to answer them. I'm going to go ahead and shut down my slides.
Perfect. Thank you very much, Craig, for your insightful presentation. Before I jump into some of the questions that we have, I believe there is a question from an audience member. I think he was referring to one of the policy options that you had mentioned for rules rather than discretion. And if you could refer to that, to which Nobel laureates were affiliated with that paper and what the title of the paper is, if you could put that in the chat, or if
I can just say, yeah. So it's Kidlin and Prescott. And the title of the paper is Rules Rather Than Discretion. I think it's the 80s. And their example in the paper is they talk about flood risk, whereas you can tell people, you can't build in this area and we're not going to bail you out. And they set it up, mathematically, but they show that when the flood occurs, it can be better for you to bail them out, even though you said you wouldn't.
Perfect. Once again, I'm going to invite all participants to include any last minute questions in the Q&A chat box below. I see them coming in. So often there is a bump in risk perceptions during and immediately following a hazard event that then scales down over time, but there's usually a gap in time between the disaster and then actually receiving official aid. Do you think that this may contribute to furthering charity hazard? And is that an argument for speeding up aid payments?
Yeah, so I totally agree about I think people have called it a half-life of risk perception, where they become heightened in the wake of a disaster and they kind of decay after that. In general, I think getting the red tape out of the way, people would be a lot more satisfied with payments that were more timely. That's been an issue with buyouts too, where you can contract for a buyout, and if the payments aren't made in a reasonable time frame, people have a bad experience with relocation. Whether it feeds into charity hazard, I don't see directly how it would. I think the way I would explain our charity hazard results is just that there tends to be a misperception that government assistance can be a good substitute for insurance. And I think if you combine that with the idea that flood risk has a low probability, so maybe it doesn't cross a threshold. So if you imagine you have a mental model where you're thinking about what should I be worried about, and you think about flooding and you realize it's not that likely. And then if you combine that with the idea that there's disaster assistance out there, so it's probably okay. So the idea of thresholds and having a substitute risk management, I think, is what contributes to that. So my argument is that explaining the inadequacy of disaster assistance payments, especially for home damage, which insurance is designed to cover, would be, I think, a good tool to combat charity hazard.
Perfect. And we do have another question. You noted that there is a different behavioral response to flood map information on FEMA versus First Street. We spent a lot of time and resources trying to produce maps and improve their accuracy. What is your perspective on the use of these tools to influence behavior to purchase insurance or invest in mitigation?
So one of the analyses I'd proposed to do with First Street was to try to assess the impact of the rollout on insurance uptake and housing prices. It's something I haven't been able to do yet. I'm still looking for a student to help me with it. And there's a confounding factor, is that the NFIP is raising their flood insurance rates this fall. So that's going to have an effect as well. So it could be hard for us to tease out what is due to information and what is due to price changes. So I've kind of held off on trying to do the analysis until some of the uncertainty clears on exactly what's going to happen with rates. because Congress has blocked rate increases in the past. So I'm not sure if I answered the question or not. So here's an interesting thing about First Street is they are being very aggressive at trying to get their flood risk information out there. And they're using really good state-of-the-art methods in trying to forecast. So their information includes past flooding, current risk measures, and forecasts with climate change, which the flood maps don't include. They've been working with some of the data providers on housing to incorporate their flood risk measures into, I don't think Zillow is one of them, but for example, if you pulled up a Zillow page, it could have the First Street flood risk information there, because states vary in their disclosure provisions. Some of them have none, where you're basically buyer beware to know whether you're buying in a flood zone or not. So getting that information out there, I believe, is going to have an impact. I think it remains to be seen. But what's interesting about the First Street rollout is it started in the South, and then I think they went to the Northeast, and then the Midwest, and then the West. So from a researcher's point of view, that's great, because we've got kind of it's not randomized, but at least it's not all at once. So if there is an impact on flood insurance uptake and housing prices, we'd expect to see it in the South first and then the Northeast. So at least we have controls if we want to do that assessment. And again, like I said, that was one of the things I was planning to look at and haven't got started on. I need to apologize to First Street for not doing that. It's something that I'm planning to do.
Perfect. And we do have a few last questions. So which data, this is more of a technical question, but which data is primarily needed to calibrate and validate the models you have described in your presentation? And is spatial data used for this type of modeling?
So the instruments that we're using were mostly designed by the folks that I work with. I don't think we have a standard for measuring risk perceptions, at least in my field. Which is good and bad. I don't think we found the right way to do it, and I don't know if there is one right way. So in the future, what I plan to do and what we did in this last version of the survey is to use a lot of different questions. I think I brought this up in the talk, that the idea of triangulating risk perceptions, for some people, a Likert scale might be the easiest thing to answer, whereas other people might do well with probabilities. So ultimately assessing all of those and seeing which ones work for different kinds of folks is something that I would like to look at. But to answer your question, there's not really a standardized approach. I think everyone does it in ways that they think make sense. We tend to do pre-tests before we do surveys. We get feedback from people that might fill out the survey, and we try to adjust. If you wanted to do the analysis that I did, I'd be happy to share the survey with you, and you could build on it or adjust it. But there's definitely not a standard, and that's pretty much true with a lot of survey instruments, unless you're getting to a specific valuation methodology or something like that. But there's typically a lot of leeway in how you design a survey. And I think you asked about spatial data. The only spatial data in our survey would be the idea that people are distributed across space and they do face different risks, but it doesn't really factor into the way that we design the survey questions. It would factor more into the objective risk analysis that looks at hydrology and hydraulics and weather patterns and all those things. So it's definitely not explicitly spatial. There could be some spatial spillovers in terms of possibly social. I don't know if there could be neighborhood effects where there could be a leader in a certain neighborhood that has a really strong opinion, and a lot of people tend to buy into it, where there's this belief that flooding is not a problem because the guy who's lived here forever says it never floods. So there could be some social spatial effects, but we don't have the kind of data to pick that up.
Right. And I think there's you might have covered this already, but we'll take one last question. So sometimes respondents in studies overemphasize responses simply because researchers are asking questions about a particular topic. Right. In your research, you found that homeowners overestimated flood risks compared to objective assessments. Have you tried basically burying your flood question within a more general question about all risks facing homeowners? This might trigger more of a natural response.
Yep, that's a great question. I totally agree. We call this salience. If something's too salient, you can change the way you can change the response. To balance that, you also don't want to make the survey too long. I do think that's a great idea in terms of measuring risk perception. Put it in the context of other risks like car accidents. I I've not tried that. I did do that in the worry measures, though. We talked about worrying about home loss and livelihood. For those worry measures, because it was not a long question, we did embed the worries in a list of other worries. So we talked about not having friends, not feeling, losing your job. And that should be effective at kind of reducing the salience of flood risk relative to other risks. We have not tried that in risk perception. I do think it's a good idea. It would eat up some space in a survey, which you do try to keep short. But I think it's a good idea. And I do think doing an experimental study where you embed it in one and you don't in the other to see if it has an influence is a good idea.
Absolutely. And that's going to bring us to time today. So I just want to thank everyone for your great questions. And I want to thank Dr. Craig Landry for your insightful presentation. I think a lot of the participants really enjoyed it, and hopefully this adds to some of the work that they'll contribute as well. And if you're interested in learning more about CCRF, please visit our website at uwaterloo.ca/CCRF, and we'll be sending out a recording to the webinar presentation in the following week. Once again, I'd like to thank our audience and our presenter, and we hope you enjoyed today's webinar presented by MEOPAR and the Canadian Coastal Resilience Forum. Thank you, everyone.
Thank you.